The Kotak Standard Flexi Cap Fund, also previously called the Kotak Select Focus and Kotak Standard Multicap, has undergone a few changes in its name in the past. The fund was being run with a predominantly large cap bias prior to the recategorization in 2018. It has since been renamed as a multi-cap fund. More recently, the fund moved into the Flexi Cap category when SEBI launched this category in 2020. We think that the fund is backed by a very capable manager and it has the backing of a strong as well as an experienced team. Harsha Upadhyay has been managing this fund since 2012 and his execution is reflected in the fund's long-term performance. The portfolio consists of about 55 stocks, with the top 10 holdings accounting for about 55% of the fund. The fund is a high-growth, low-momentum strategy, and this is evident in the manager's style of investing. Turnover numbers on the fund are on the lower side, and inflows are typically deployed into buying more of existing stocks rather than investing in new names. Upadhyay favors growth stocks that have sustainable competitive advantages such as brand name, business, and market share. Those that are scalable and generate steady cash flows and have good management capabilities. He also looks for stocks that trade at reasonable valuations. The aim is to invest in long-term growth stories. He also places a lot of focus on investing in high-quality businesses that are unlevered. The fund is run with a large cap bias, and although the mandate allows it to invest up to 50% in small and mid-cap stocks, the manager typically holds about 20 to 25% in this segment. Financials occupies the largest portion of the portfolio in terms of the absolute weight, despite only being slightly overweight versus the S&P BSE 500 Total Return Index. Other sectors that carry an overweight position include basic materials and industrials, with stocks like SRF Limited, Ultratech Cements, Bharat Electronics, and Larsen & Toubro carrying overweight positions. The fund is considerably underweight in the defensives, healthcare, and utility space. Within the defensive space, the fund owns stocks like Hindustan Unilever and United Breweries. The investment process is well defined and has been executed well under Upadhyay's lead. However, a slightly conservative approach and benchmark consciousness may constrain the fund's performance to some extent. The fund suffered in 2020 and 2021, which in turn impacted its cumulative showing across time periods. A momentum-driven market led to some loss of alpha on the fund. Moreover, the manager's underexposure to metals and mining has also hurt them. This is the largest fund in the category. It's also currently the largest equity fund in the market. Although the mandate allows it a lot of flexibility and the approach that's followed mitigates concentration and liquidity risks, we think that's important to monitor the fund's growth and the impact of its size on the overall execution of the strategy. Moreover, the fund's small and mid-cap exposure can have a significant impact on its performance. It's important for investors to remember that the fund's success largely hinges on the manager's ability to allocate stocks across market caps and pick the right stocks.